Okay, welcome everybody. This is the speculator at Take Your Profits. Here's a take two on the post-trade operation, another series of post-trade operations here tonight. This is going to be the post-trade review for trade number 94, which was a long entry in the British pound US dollar market. Going right into the charts, I just want to go ahead and look at the details of my technical analysis. We can see here we got immediately off the bat what I can identify is an AB, CD harmonic pattern with equidistant moves from AB to CD, completing at a retracement area, an 886 retracement of this XA leg of this underlying upward trend, which is the direction I was basing this trade decision off of. In this particular case, we had a double bottom here in price structure, in which I was anticipating there was going to be a retest of the price structure here at this. What it turned out to be was, price was trading at this Fibonacci zone, and where we had the 886 retracement. We had also indicated by this light blue horizontal line here, area of higher time frame confirmation based off of a trend on a higher time frame, in which this blue line was the 50% retracement of that higher time frame. So once I saw this little Fibonacci cluster here, I knew that I was dealing with a probable area to take a long entry at. And considering, now the thing is what we're looking at here is this is a daily chart of this particular market at that time period, and considering that this is a daily chart, this area where I actually ended up entering at, from this area to even this area, looking at this level of structure, it's quite a significant amount of pips. So in an effort to minimize the amount of risk I was going to have to make myself responsible for, I had to move down to a smaller time frame. But before I move into that smaller time frame, I also want to note that once we did have this Fibonacci cluster where price was trading at, we could see that once I took a Fibonacci extension off of this AB leg, there was a targeted zone between the 127.2 extension and the 141.4 extension, in which this price level seemed to be respecting. On top of that, which is also more interesting to note, you can see it looks like we got a bearish five-wave pattern cycle here. This can be interpreted as 1, 2, 3, 4, 5 wave with a ABC wave retracement before going short. So that's a pretty now that wasn't something that I actually traded off of, but looking back in hindsight now, identifying that's pretty interesting. I'm not necessarily an Elliott wave trader, but being able to spot those those five-wave patterns is interesting, and something I find very interesting anyway. So this being that this was a daily chart, in order to find the exact locations I was going to make my entries and place my protective stops and targets at, actually my targets were a function of this downward trend. I just take a retracement from this point A here to point D, and I set my targets just short of the 382 retracement here and just short of the 618 retracement here for the secondary targets. Going into the lower time frame, which I based the final trading decision off of, even though what I was looking at here was an overall Gartley pattern on the daily chart, with very nice fractally divided price movements, as I noted here with the five-wave cycle there we looked at. I really had to get down to the smaller level and to the smaller time frame, because what I was really making the trading decision off of was this double bottom and price structure that we found to be forming. And interesting to note, because on top of this double bottom in price structure that I was attempting to base this trade strategy off of, this is something I don't trade, but you could also see, this is going back to the pattern within a pattern concepts that I was looking at in the previous trades. But in some of the blogs online, I've noticed that this particular pattern right here is classified in, some people do anyways, they classify this as a crab pattern, which I guess is a cousin to the Gartley. But if you look here we got a X, A, B, C, D with the crab pattern ratios. That I didn't really even measure those ratios because it's not something that I trade at all. But it's interesting to note, in looking at this double bottom and price structure, in order to find the exact location in which I actually place this entry, which is signaled here by this yellow horizontal line, which is where I finally place the entry. And looking at this double bottom, seeing this secondary crab pattern, which I'm only aware of, which I don't trade off of, it helped, it helped to build my confidence a little bit more in making that decision to execute that trade. But in any case, I did decide to finally execute the trade here at the 53.79 level, and in doing so, I placed my protective stops here. If I'm not mistaken, 53.79, 100. It's 100 and I don't know. Let's call it 150 pips or so. In any case, that 150 pips was probably like a 3 ATR protective stop, which is usually, it's a little bit more than what I have defined. What I have defined for my trade strategy is a 2 ATR. However, my strategy, my trading plan does define that my protective stops do default to structure regardless of the ATR count. So that level was probably, it's protecting this. Actually, it was right here under this structures, which is the true protective stop zone for this Gartley pattern. Is underneath this structure is where this protective stop was placed. Even though I was playing this double bottom, still, once, if I would have seen price break through this double bottom, I would have started getting concerned and started thinking about reducing this stop as quickly as possible to prevent any further losses. However, going into some of the photos I took to, updating the position, let me try to zoom in on this. Now, at the end of the day, we're still looking at the same Gartley pattern on the overall larger time frame. However, actually, going back to that other, this was the original. Yeah, and actually, as can be seen here, that this double bottom and price structure started looking very attractive. Once you just started paying attention to the price structure here, you can see we had a crossover here in extreme stochastic territory, indicating a shift from seller to buyer sentiment. And once this formed its structure, we can see that within this stochastic oscillator, there was no real follow through. Once price hit this level of minor structure over here, when it formed this overall crab pattern. And I guess what it was doing was just this is where the buyers were starting to build into this particular market. And as it did so, we can see there was, within this oscillator itself, there was levels of, this was the new structure low. This is a higher low. Here's a higher low, indicating our first level of bullish divergence, which eventually worked itself out with this lower low. However, this lower low is actually higher than this low, creating a new higher low. This low again is another higher low compared to this low, and then here we go. We start really forming our new bullish divergence with this new higher low. And then once the percent, this is the percent D line, which is the signal line in stochastics and the stochastic oscillator. Once this yellow percent D signal line showed that it wasn't going to follow through in seller sentiment by not crossing over this extreme level here at the 10 level, I started to anticipate, which in some cases can be argued as wrong. You shouldn't really anticipate, but at the end of the day, you gotta, you gotta make money. So I anticipated that at the end of the day, this was going to cross over, giving us our full level of bullish divergence, based on the fact that there was just the stochastic oscillator respected this level of extreme seller intervention here. And the same thing happened on the MACD indicator. You know, this great big bullish divergence was playing out, and when I saw actually the level of momentum was relatively decreasing from the previous measured levels of momentum, I again anticipated that this eventually was going to just cross over once the buyers continued on piling into this market. So I anticipated that this market was going to break. So once I identified this, the market was playing this level of price structure, you know, I anticipated and predicted that, you know, buyers were going to, you know, cross over, that the stochastic oscillators and the MACD oscillators were going to cross over. So I therefore decided to enter my orders to enter the market here at this level here at the 53.79 level. So I executed that trade. I placed my protective stops here below the structure indicated by the point X and the Gartley pattern found in the daily chart. Place my protective stops, place my initial targets and my secondary targets, and played that. So what happened was that, well, this is what we were looking at before actually. What happened was that you see, we ended up getting that complete bullish divergence. I was right to anticipate the crossover was going to happen. The crossover happened. So you can see here we didn't break into overbought territory, so there wasn't really a strong amount of buyers, really no real follow through here. But we can see where the momentum did shift strongly relatively to the, you know, rest of the previous momentum over, even from the week before, was about say 30% stronger than the momentum from the week before. We were still in seller territory, so there was still weakness in this market, which is why there was no real follow through in stochastics or in price even, as once we got this initial pop in that market, I noticed that price began to retrace somewhat, which is okay. You got to give, after any significant move, you got to give the market time to retrace a little bit to recover before it advances onto its next move, in order to allow buyers to pack in and build into this market here at these levels. But once it started to do that retracement, I started noticing that there was a possibility here of an inverse head and shoulders pattern. This looked like a left shoulder here. This new structure low here looked like, you know, the inverse head. And once the market popped and formed this new structure high in comparison to this previous high, it looked like this, you know, it looked like this could potentially be the new neckline for the reversal pattern that seemed to be shaping up here. And I asked myself, was this going to be the right shoulder here at this 382 retracement of this impulse leg that just occurred here on this 1, 2, 3 wave impulse? I don't know. But what I did was, based off that little move, you know, any move indicating that my strategy was right, I start moving my stops immediately, because, you know, the game's about protecting my capital and reducing the amount of risk I'm responsible for, because the goal at the end of the day for me anyways is to end up on a risk-free trading opportunity, so that way I don't have to have any of my own money at risk, so that way I can just be in a position where I can turn a profit from whatever the market does, whether it goes up or down. So in this case, I started questioning this, and because I questioned it, I reduced my risk, because I didn't know what was going to happen. But in this case, being that we did have an impulse, I did have to give the market room to trade and move a bit. So I was still at a 50% reduction of risk. There was still money to be lost on this trade if the market decided to just move completely against us, which at this point, you know, most people might consider this, you know, look at this downward trend here. You know, yeah, sure, it's on a minor level, only on the 1 hour chart, and you can't really see that secondary bottom right now because it's not covered by the chart. But, you know, somebody could at one point or another interpret this as a, you know, a small rally, you know, a small correction in the overall downward move. But You know, that wasn't the game plan here, because we were looking at the higher time frame on the daily chart, which matters most. And what, you know, this counter trend strategy is, although it's counter to this ABCD downward harmonic trend right here, and it's counter to that, and I'm looking to, you know, make a buy at an extreme level of selling interest based on price action, at the end of the day, that buy is at a level of retracement in comparison to this XA upward trend. So my counter trend move is actually a trend continuation trade in comparison to the longer term time frame. You know, this trend dates back to 2010. So I'm looking at overall larger market moves to pick up some big gains here, and that's really the name of the game here. So once I saw the market was agreeing with my idea, I started reducing that risk, and I started looking to identify a new right shoulder here in order to look for another possible area to reduce risk, to get to a level where I could be doing some risk-free trading. So going into the second picture I took, boom, boom, looking good, looking good. The market, it actually retraces beyond the 382 to a 50% of this initial impulse leg here, and in retracing to that 50% level, according to, you know, this is actually a good book everybody should probably pick up, Technical Analysis of Stock Trends, 9th edition by Edwards, Magee, and Bassetti. Great book to read. 9th edition. That thing is, you want to learn Dow theory and all the old school stuff, it's all there. Charts dating back to, God knows, my 1900s. But anyways, according to that book, we got a saucer-like formation happening here, consolidation pattern, which, you know, here's another one. Boom, saucer, 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 and these are, you know, consolidation, continuation patterns, you know, that, you know, you can trade off of. So based off the fact that the market formed a new level of structure here with this saucer pattern, you could call it whatever you want, bowl-shaped pattern, I don't know, you know, it's just a new level of structure that the market formed at a level where the market formed the previous level of structure. And if you can see, our neckline that we thought was going to be slanted, actually the neckline is here at this 50% retracement of that higher time frame. It's closer to here, you know, maybe just below that 50% retracement. And here's, you know, here's a neckline of that inverted, you know, head and shoulder here, and this is the structure formed by that right shoulder. So what did I do? Here's my stop loss here for those 60,000 units, placed it just below that level of structure, because what I wanted to do, here's my entry, here was my initial stops with a 3 ATR. We no longer have any money at risk. I went ahead, once the market showed its intention to move in the direction that my strategy predicted it was, you know, supposed to go in, you know, the market formed a level of structure that was telling me was a good place to protect the profits that I had made. 50% of the move that the market had made. It was, you know, that's the market telling you, hey, I'm willing to give up 50% of the move that I made. Take it or leave it. Put your stops there or not. But you don't know what direction it's going to go in, right? So, you know, being that nobody can tell the future, and based on the fact that we had a confirming level of structure over here, you know, I placed my stops there. And that's what I did. So, what happened? Well, this is what happened. The market said, all you're getting is 50% of that previous move, which is okay, because that means I turned a profit, right? So, is that enough rationale to answer that first question as part of my trading plan here for post-trade operations? Did everything go as planned? You know, can you answer yes? Did everything go as planned? You turned a profit? Yeah, you can kind of say everything went as planned, but I did turn a profit in a sense, right? I participated in a risk-free trade, right? I'm going to say 50-50. Kind of didn't turn a plan, kind of didn't go as planned, kind of did it, whatever. It didn't because I didn't hit my initial profit targets, right? Why didn't I hit my initial profit targets? Well, you could argue it didn't because I got stopped out, trailing my stops above break even, trying to participate in the risk-free trade. How could I improve upon that? Well, considering, actually it's going to come up in another video after this that I'm going to publish hopefully tonight. I'd like to finish it, but in the other account that I trade, the systems strategies, the third-party system strategies that I trade, the system actually signaled a long entry right about this retracement here, which was actually a good location to risk to take a trade at, considering that the risk was only going to be, whatever this is, being that the stops were going to be placed below this level of structure. So, considering that I know the future at this point, and I can say that hindsight is 20/20, I could definitely argue and say, oh, I should not have trailed my stops so aggressively. I should have protected only this level of structure and waited for this candle to close above the true neckline of the market here, and I could have not been so aggressive and waited for the market to turn around, and I would have participated in this account on that big move that I didn't participate in this account, but I did participate in the other account. Right? Yeah, I could say that. Well, the fact of the matter is I can't, because I don't know the future. And at this point in time, when I was trading the market, trailing those stops, when the market was right here, let's just say, right, when this candle's trading at, at the market, you don't know the future. So there's no reasonable argument, rational argument that I could use to justify leaving my stops here and potentially turning this trade into a loss after the market gained, I don't even know if this was, so after the market gained 80 pips, the market's going to gain 80 pips, actually it's probably 100 pips, right? I took out 40 from this particular trade, right? The market gains 100 pips, and you're going to gain all those pips and watch all this movement happen with this. Look at this could be interpreted as a double top even. So once I saw this double top, I was like, there's no way I'm going to lose money on a double top after having participated in a move of 100 pips. My goal here is to make money and have a steadily rising equity curve. In order to do that, I need to take profits when the market moves 100 pips in my directions at some point or another. I need to protect at least 50% of that move. In some cases I'll protect, only up to 2/3 of that move, but nonetheless I got to protect a substantial portion of that move, because at the end of the day I don't know the future, and I don't know the direction the market is going to take, and I'm not going to sit there and watch the market eat away 100 pips of profit that it easily gave up to me in a matter of 8 hours. So I'm gonna have to say that I was correct in deciding to place my stops there. However, the trade did not go exactly as planned, right? So going into how this trade was planned a little bit more in detail, let's go to the Pro Trader dashboard and let's look at the exact technical details of this trade. This trade was so last Tuesday, October 4th, taken out in the New York session at 9 a.m. Lasted 1 day. Long entry in the British pound US dollar market, decided on the 4-hour chart. Trade number 94 came out for a small win. That win carried with it a 2 ATR stop loss. It was actually a 3 ATR, structure. 60,000 units. And actually it was taken out on trailing stops at better than break-even or best offer level, at the or best offer level, whatever, for a small gain of 35.4 pips in my attempt to profit from a risk-free trading event. And that added to my total pip gains for that third contract of 40 to I jumped up to 45.93 pips I've gained so far on that particular contract. In total for the year on all three contracts, it's about 7,000 pips I've gained. looking at the technical details and profitability numbers and probability numbers and percentages and whatnot. This trade carried with it a 3.35 risk profile based off of that small amount of risk I was taking responsibility for. The technical scores did allow for a complete one contract position size based on the mathematically defined risk parameters and money management parameters. It did technically score a combined technical score of 11 points. Here are the technical details, the technical components of the trade. It did score points for a stochastic MACD crossover and for trading at a major level of structure. Here are the probabilities and the whip percentages for each one of these technical details overall on my whole trading plan. It did score points for ratio confirmation here. Did score points for higher time frame confirmation. Did score points for an ABCD harmonic pattern with a 786 retracement, as I showed you on the daily chart there. And here again are the probabilities. Every trade that I take with an ABCD pattern harmonic move has a 50% chance of winning, and so far to date I've earned $3,000 on this one technical detail alone. Same thing goes here for higher time frame confirmation. $7,000 in gains on this higher time frame confirmation, $3,600 in gains on ratio confirmation, with 40 and 43% win percentages respectively. Did score points for a Gartley 8 pattern with price trading at the 886 retracement of XA, as I showed you on the daily chart, which was the underlying trend, upward trend dating back to 2010. That trading style right there has showed a 42.86 historical percentage of winning, and to date so far has earned me about $4,300, this component alone. I did score points for bullish divergence, which to date has scored a 27.5% chance of winning, which does have a net losing figure associated with that. This overall trade though, however, this micro trade, let's call it, within my overall rule, defined rules of engagement, did show a 36% chance of winning, with a win-to-loss ratio of 1.5, meaning that I win 50% more than I lose, and the total year-to-date profit for this particular micro trading strategy has been $988. So going into the second question, the trade didn't go as planned because it got taken out on trading stops at a level of price structure, but it was still a win. So at the end of the day, I left with money in my pockets. So the only thing left to do is to ask myself and to look at this as objectively as possible in order to figure out what can be done to improve upon this trade based off of those technical characteristics that were found when I analyzed this market. And what can I do to improve? Well, I ran this whole trade through the framework of identifying, predicting, identifying the technical characteristics that were going to lead to a probable opportunity. Based off of those technical characteristics, they predicted a direction in which was highly likely to be profitable for me. And based off of that mathematically defined information that I was able to put together with the use of the Pro Trader dashboard, I decided to execute a few orders and enter the market in the direction that I predicted. Okay, going through that whole framework, and then according to the narrowly defined rules of my rules of engagement, which lead me to a very narrow path in which I can actually trade and approach and participate in these markets, based on the fact that I engaged the market and approached the market exactly as outlined in my business plan for this business, my trading plan. And based on the fact that my confidence levels and my psychology and my emotions were able to be maintained at a stable level because of the mathematical statistics and probabilities I was able to use in order to stand on a firm psychological foundation in which to trade from, using the tool that is the Pro Trader dashboard. I gotta say, there's not much to this trade that can be done better. Because I traded, I traded the market according to my own game. I played it how I'm supposed to play it. It wasn't a stellar victory, but it was a victory nonetheless. It was a small skirmish that was won, and I was able to leave with more than I had. So I was able to identify this inverse head and shoulders, which there's not much more to that. I mean, you see two shoulders and a head. There's not much more to that. If the market shows you that and you're in profitable territory and you're protecting the profits and the movements that you've gained, there's not much more that can be done to improve upon that. So objectively, the only thing that I can say that is going to lead to continued success trading this strategy and playing my game is to remain consistent and remain committed to trading this strategy and these and taking these mathematically defined points of entry based on the rules of engagement that I've outlined for myself. So the only thing that I see that can be done in order to continue doing what I'm doing is to stay on the path of success that I've been on, which is the path of consistency, the path of discipline, persistence, and the path of consistent, committed execution. I just got to keep doing what I'm doing. My attempt here was to participate in a risk-free trade, which works, I don't know, 8 times out of 10. It works a bunch of times. When it doesn't work, what happens? I exit with a profit. I exit with a small profit, 38 pips, whatever. Most people, I don't know how many people out there wish they could take 38 pips from the market, but I'm sure there's a bunch of people that wish they could take 38 pips from the market consistently. So I'm grateful that I can do so, and do so with the opportunity to take 500 pips if I continue to put myself in these risk-free trading opportunities. So the quicker I could get to a point where I'm not risking any money, while simultaneously putting myself into a position to participate in larger, more meaningful moves, I'll do that 100 times out of 100. So that, at the end of the day, ladies and gentlemen, is the conclusion of these post-trade operations. This was the post-trade review for trade number 94, which was the long entry in the British pound US dollar market. Did show gains for about 38, 40 pips. It did go as planned because I did turn a profit, and there was a good way to improve upon this trade, which is the only way to do so, which is to keep doing what I'm doing, which is to keep trading my plan in a disciplined and consistent fashion. So thanks for listening. This is the Speculator signing out. I appreciate all the listeners here. Hopefully I do this at the end of the day to help myself, because documenting all these videos really helps me to stay on track. But at the end of the day, I do hope that some of this information will get out to the right person and help the right person achieve the same success that I'm putting together for myself. So thanks for listening. I hope this helps. This is the Speculator signing out. Don't forget, take your profits.